There's been a renewed interest in travel stocks, but is the travel industry a value trap? Or is this a deep value opportunity? Now, to answer that question, I've broken this video into three main parts. First, we're going to talk about the headwinds and tailwinds of the travel industry. And then we'll go over the earnings result of both Webjet and Flight Centre. And then I'll wrap up everything with my own observation on whether the travel industry do present a value play. I made some changes in my portfolio as well, so I'll make sure I share that with you towards the end of this video. As usual, because I didn't fulfill my Asian prophecy, no, I'm not a professional. And this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes to hopefully brighten up your day a little bit more. So as the borders reopen again, especially the international borders towards the end of this year, there are plenty of speculation whether Webjet or Flight Centre will bounce back like a pogo stick. Just to give you some perspective, what you see on the screen is the vaccine rollout process. The first week's goal was about 60,000 doses, and we managed about 31,000 in Australia. Even though the early stages of the rollout program has been a little slow, some believe the approval of the AstraZeneca version will speed up that rollout program. On top of that, the fuel prices at a 13-month high really doesn't help the airlines. Not to mention, the airlines will have to work through the scars of the pandemic and help people feel comfortable again to go travel. But part of the optimism and excitement around the travel industry is the government, our government's 1.2 billion support package, where nearly 800,000 airline tickets will be half-priced. The destination the government chose are regions that really depend on international visitors. So these are places like Gold Coast, Alice Springs, and Cairns. And I want to do a quick poll in the comment section below. If these domestic airline tickets are half-priced, will you personally take advantage of those? For me personally, I've been taming my travel bug by taking short trips to the coast. And because of work commitments, I don't think I can suddenly just fly to the Gold Coast, do some YouTube videos there, and then come back. Actually, I might take advantage of the half-price tickets to potentially visit you guys in different cities. So I've established that the vaccine rollout, oil prices, and scars of the pandemics are headwinds to the travel industry. And the massive government support for the industry will be a tailwind for companies like Webjet and Flight Centre. Before I talk about whether the travel industry could be a value trap, let's go over the earnings result of both Webjet and Flight Centre. For Webjet and Flight Centre, they've had a really tough time in the pandemic and even now. So for this earnings result, I'm looking for signs of recovery in demand and how they're managing their expenses during these times with little revenues. Now, if we take a look at Webjet's earnings result, yes, the pandemic has been really damaging, but overall, since the borders have started to reopen domestically, you can see the demand starts to pick up. And that's really encouraging to see. And it makes me even more curious to think about what the 1.2 billion government support package will do to demand, because these numbers only reflect up to December. If you want to understand the business model of both Webjet and Flight Centre, especially their true competitor hidden in plain sight, make sure you check out that video on the screen, and I'll leave a link in the description box below as well after this video. Now, if we take a look at a 12-month chart on Google Trends between Webjet and Flight Centre, you can see that this chart lines up really well with the pandemic. And since the borders have started to reopen, you can see the interest started to grow, but the gap between Flight Centre and Webjet have also started to widen as well. And I think a big part of that is just Webjet attracting more of the younger audience versus Flight Centre attracting more of the mature audience. Now, for those of you paying attention to the travel industry since the pandemic, the metrics across the board were just not pretty. Now, revenues was down about 90% compared to the same period last year for Webjet. However, Webjet did take some extreme action to reduce their expenses. And compared to the same period last year, their expenses is down 52%. Now, Webjet is burning approximately $5 million per month after taking into account working capital. But let's just say if we're more conservative and say that they're burning about $9 million per month, with $283 million left in the bank account, that's a very long lifeline that they have before they have to go raise capital again. And I don't think their cash burn position is as bad, only because the borders have started to reopen, and with all of these half-price tickets flooding into the markets, I just don't think they'll be burning as much money moving forward. Now, for Webjet's core business, their EBITDA has gone back to positive, which is really good to see. But it's also worthwhile noting that if you look at revenue, it's a fraction of what they did in the same period last year. So don't expect too much. It's going to be a long road to recovery.
For their B2B business, they've done what they could to reduce their expenses by more than 42% compared to the same period last year. Revenue is a tiny fraction of what they did in the same period last year, with a negative 32 million EBITDA. It's a similar story for Online Republic, where they focus more on motorhomes and car rentals for international travelers. And the way I think about Online Republic and Webjet is that I think of them more like a growth lever that Webjet can pull when international travel resumes later this year. Hopefully.
Now for Webjet's earnings result, I wasn't expecting that much. I just wanted to know how much money they are burning per month and how much cash they have left, just so that I can see whether they can survive long enough to see the light of day. With $283 million in cash, I think that's more than enough for them to see the light of day. And there is the added benefit of Webjet being a more digital focused business that they don't have to deal with the physical retail footprint expenses like Flight Center.
With Flight Center, as much as I want to show some graphs to keep things spicy between me and you, their presentation is very vanilla, so you gotta bear with me. Now, similar to Webjet, majority of Flight Center's revenue is at a fraction of where it was same period last year. And because they have physical footprint as well, it just naturally comes with higher expenses. In saying that, Flight Center have taken massive actions to significantly reduce their expenses, raising additional capital and some more. Now, the cost of the capital raise significantly diluted the share ownership. But honestly, what choice did they really have? Now, if we take a look at some more tangible numbers, Flight Center have reduced their expenses by 66% compared to the same period last year. And with a 1.2 billion worth of cash in the bank account, it should provide enough of a lifeline to survive a full year plus some more. Now, similar to Webjet, I don't think Flight Center will burn as much money from here as the borders reopen. Imagine what the demand is now when the government is providing high-price tickets for domestic travels. The added benefit of Flight Center is that they are a much bigger international business. So when countries start to reopen, that might be a massive catalyst for Flight Centers to start recovering back to their previous heights. Now, in saying that, don't get too hyped. The travel industry recovery is very dependent on the vaccine rollout and people feeling comfortable enough to travel. And more recently, Flight Center have won over a few corporate deals. So I'm pretty interested to see how those corporate deals will impact their earnings in the next earnings result.
Now, before we take a look at the valuation, I just want to quickly sum up my thoughts on the travel sector. So the bull case for the travel sector is that there is pent-up demand for domestic travel, and the government is going to flood the market with high-priced domestic airline tickets. And the bear case is that the willingness to travel will be very dependent on the vaccine rollout, and the rising oil prices is likely going to hurt the airline margins, which will inevitably hurt the travel agency's margins. And I'm curious to know whether you're leaning more towards the bull case or the bear case. Okay, let's look at the valuation for both Webjet and Flight Center.
Now, this is a comps table I use to keep myself posted on what's happening in the travel industry. And I've added corporate travel management, bookings, and Expedia Group just to make things a little bit more exciting and for fairer comparison. So let me go over the columns and then I'll provide some commentary on this comps table. Now, percentage of 52-week is to help me understand what is the current share price when compared to the 52-week low and 52-week high. Market cap is market cap. Enterprise value is something that I calculated myself, not using Yahoo Finance numbers. LTM stands for last 12 months and NTM stands for next 12 months. So these numbers are more projected by analysts, and these numbers are also projected by analysts as well. So CAGR stands for compounded annual growth rate. So these are the numbers that analysts are expecting these companies to grow their revenues by over the next 2 years. If we take a look at this comps table, the average EV revenue is about 16 times, but Webjet and corporate travel management is trading at a premium, in my opinion, because they have a massive estimated revenue growth rate over the next 2 years at 140%. And 96% for corporate travel management. If you take a look at Flight Center, even though they're estimated to grow at 75%, they are trading at a 7 times EV revenue. On the surface, it might seem like they're undervalued, but we also have to ask the question, why are they valued at such lower multiple when compared to the other two? Is it because of the massive share dilution they did because of the capital raise? So that's really worth digging into some more. Now, bookings.com look relatively reasonable at a 14 times revenue at a 44% revenue compounded annual growth rate. But it honestly blows my mind that Expedia is anticipated to grow at 44% compounded annually, but they're trading at a 5.8 times EV revenue and an 8.5 times gross profit.
At the end of the day, you have to decide for yourself whether you're a believer in the bull case or the bear case for the travel sector. I personally think the government supporting us with all of these half-price tickets will help, but the true growth really lies in international travel. What I'm really not sure about is how long will it take for people to overcome that psychological fear of traveling overseas after the pandemic is officially over. So personally, because I'm more interested in software, e-commerce, and battery supply chain, travel sector has been more of a no-go zone for me.
Now, just to do a quick portfolio update, my CMC market side of things is worth about 86,000 Australian dollars, give or take. And over the week, quite a few positions have recovered. Like for example, my SPACs have not lost as much money, which is good to see. At the same time, I've added another $4,500 into Asia, and majority of the reasons I have documented in my high growth ETF video. Now, for my stake portfolio is worth about 39,000 US dollars, which is give or take approximately 50,000 Australian dollars. Now, over the week, I added one Amazon share, and Dropbox is actually free stocks that was given to me if you do decide to try stake for yourself. And no, I'm not sponsored. Everything else has been exactly the same. I haven't really changed anything for everywhere else. And I still have approximately $1,300 I need to deploy. So when I do deploy that money, I'll make sure I'll let you know as well.
So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.